What's up YouTube? I'm back again with another video, and today we're going to be listening in on the Rolls-Royce 2021 full year results that were released on the 24th of February 2022. As you're probably well aware, after the presentation the stock dropped 20%, so let's see if we can find out why. This did happen right at the onset of the Russia-Ukraine conflict. Also, the CEO Warren East announced his departure and could be the reason why the stock received such a lashing. So, without more to say, let's get right into it.
Hello and welcome everyone to our 2021 full year results presentation. I'm Isabel Green, Head of Investor Relations, and I'm joined today by our Chair, Anita Frew, our CEO, Warren East, and our CFO, Panos Kakoullis. Before we present our results, I'll hand over to Anita to say a few words on our other announcement this morning.
Thank you, Isabel, and good morning, everyone. You'll have seen our announcement this morning that Warren plans to step down at the end of this year. By then, Warren will have spent 10 years on the board and almost 8 years as CEO. A relatively long tenure and a tribute to his strength and commitment. As a result, we're now starting an open and transparent search process for Warren's successor. Warren has a real passion for the business, which engenders pride in our people and confidence amongst our stakeholders. In his time at Rolls-Royce, he's created a dramatically different business and has positioned us well to generate substantial value from the drive to net zero. Finally, I would just like to thank Warren on behalf of the whole board for his tremendous work. It's not over yet, though. I know that while we carry out the search for his successor, Warren will continue to lead Rolls-Royce with all the dedication he has shown throughout his time at Rolls-Royce. I now hand back to Isabel to introduce today's results.
Thank you, Anita. Today's presentation will begin with a summary of our improving performance and an update on our commitments from Warren, before handing over to Panos for a more detailed review of our financial results. Warren will then conclude with an update on our ambition for sustainable growth and value creation. In all, our presentation should take around 40 minutes, leaving time at the end for Warren and Panos to take your questions. Before we begin, please take note of the Safe Harbour statement on slide 2. As always, the full set of results materials can be downloaded from the Investor Relations section of our website. I'll now hand over to Warren.
Thank you, and good morning everyone, and we appreciate you joining us on what I know is a very busy day for many of you. Now, as Anita mentioned, I have decided to step down at the end of this year. I'm extremely proud of what all of us at Rolls-Royce have achieved since I joined the company. Rolls-Royce today is culturally and strategically a very different business. We're also a completely different organisation commercially and operationally, much more efficient and productive, with sound operational gearing that will create value from additional growth. I'm sure you'll see some of that in our results presentation this morning. You'll also see that we have a clear vision and direction to lead the transition to net zero, and we're already seizing opportunities with tremendous future potential. I understand no chief executive's job is ever really complete, but I feel that with the advances we've made and the momentum and energy we've shown and our firmer financial foundations, now is the right time to look for the future. Now, there'll be a time for reflection at a later date. Right now, as you would expect, I'm fully committed to leading the business, so let's get on and we'll talk about that. So let's look at where we've got to and turn to the results for last year. I'd like to start by celebrating what an important year it's been for Rolls-Royce and to think about some of my own personal highlights from 2021. Now, in November, I joined my colleagues at COP26. A few years ago, we wouldn't have even had Rolls-Royce at a climate conference, but today, our business and the future of our business is all about the energy transition. In the picture on the left of the slide, I'm with the Nuclear for Climate team. You can see they represent the young workers of today, and they're drawn from multiple nations, all working in the nuclear industry. They're all really passionate about protecting the world, their world, from the negative impacts of climate change, and they're concerned about the positive contribution that nuclear can make to the future energy mix. It was particularly encouraging to speak with them and many others at COP26 about the need for our technologies in this space, and in particular the role for our SMRs. Furthermore, we showcased a number of our technologies in the green zone, as you can see in the photo on the top right of the slide. Exhibits included our double world record breaking Spirit of Innovation aircraft, which helped visitors to understand how we at Rolls-Royce can be part of the climate change solution. However, it's not just our new businesses that we should celebrate. Our established businesses are also driving our journey to net zero, and the image here on the bottom right shows the launch of one of our latest MTU hydrogen fuel cells in a microgrid at our facilities in Friedrichshafen. That's it being switched on for the very first time. It took 6 months for the microgrid demonstrator to go from decision to commissioning of the first MTU battery energy storage system, and that's a great example of our agility and how quickly we're delivering new solutions. Let's move on now to our 2021 operational performance highlights. I begin by focusing on civil, and in particular the restructuring programme. This was an enormous undertaking, building on earlier productivity and efficiency programmes. It's really transformed our civil aerospace business. The picture here is of programmable machine tools at our turbine blade facility in Derby. These machines have been transferred across from Crosspoint in the US, and they can easily switch between designs and have absolutely minimal manual oversight. This means one person can now do the work of several previously, and what used to be a time-consuming manual setup is now fast, it's largely software, creating flexibility as well as much greater throughput, and that's just one example. Moving on in defence, we're very proud to have been awarded the B-52 engine replacement programme in the US. This award secures new business for the coming decades after entry into service in the late 2020s, and it's a huge achievement for our defence colleagues. And I'll talk more about defence opportunities later in the presentation. In power systems, you'll remember at the half year we were seeing orders well ahead of the year before, and in the second half of 2021, order intake accelerated, with record order intake in the fourth quarter, giving us the largest order book in power systems history. Moving to the bottom of the slide, in Rolls-Royce Electrical, we're thrilled with the success of our 2 world records with the Spirit of Innovation aircraft. This demonstrates the real pace at which electrical technology is accelerating into the world of aviation and creating new opportunities. We're excited to be exploring the varied applications for air mobility. In the middle at the bottom, in Rolls-Royce SMR, as you know, we decided some time ago to focus our civil nuclear activities on SMRs, small modular reactors. In the second half of the year, we secured UK government grant support alongside equity investment to progress the project to the next phase. And last, in the bottom corner, but certainly not least, we're making good progress with disposals. Back in October 2020, we committed to undertaking a series of disposals to reshape our balance sheet. 3 of these disposals have already completed, and the sale of ITP Aero is agreed. It's announced, and it's expected to complete this year. Let's have a look at our financial summary. We have 3 great outcomes from the progress we made in 2021. 1, we have improved financial performance. 2, we're delivering on our commitments. And 3, we're still investing for growth and sustainable value. Our cost reductions and market growth have helped us to return to profitability in 2021. And while we still had a cash outflow in the year, you can see from the histogram on the left of the slide, this was substantially improved from 2020 and is expected, and it is ahead of expectations. And as mentioned a moment ago, our restructuring programme has delivered more than £1.3 billion run rate savings, and our disposals are on track to achieve the total proceeds of around £2 billion. Our sustained investment in research and development is enabling us to deliver market-leading technology focused on net zero, and this unlocks opportunities to deliver long-term and sustainable value in both our established businesses and the new ones that we're reporting on separately for the first time today. And our ability to maintain investment even in these difficult times is supported by a strong liquidity position with no debt maturities before 2024. Now, moving on to the next slide, I'm going to add some colour on just a couple of topics. Let's start with the restructuring programme. The activity here was mostly about civil aerospace. It was about right-sizing in the short term and then taking advantage of efficiency and productivity enhancements so that we can scale up output without a corresponding increase in operating costs. Not only have we exceeded our run rate savings target and we've removed more than 9,000 roles across the group, we've done so 1 year ahead of schedule. Our civil business operation is now about a third smaller than it was in terms of footprint and headcount, and that makes civil leaner, a much more efficient and productive business, and one that is ready for future growth. The focus now is on ensuring that the benefits we've achieved are sustained. Now some pictures of friendly faces. Before passing over to Panos, I'd just like to take a moment to focus on our executive team. The real breadth of experience and expertise is enhanced by these recent additions. So last May, we welcomed Panos Kakoulis, our CFO, who joined us from Deloitte with over 30 years' experience of managing large, multinational, multidisciplinary teams, helping major organisations to deliver change. Top right of the slide, Grazia Vittadini has joined us as Chief Technology and Strategy Officer. Grazia brings to us extensive expertise in both aerospace and the emerging and disruptive technologies from, amongst other things, her 20 years' experience at Airbus, latterly as their CTO. I think it's important that a balanced team brings a combination of fresh thinking from outside the organisation, but also deep knowledge from within the organisation. It's important to also to demonstrate to others internally that career development to the very top level is just part of how we do things around here. So in January this year, we promoted Sarah Armstrong to the role of Chief People Officer. Sarah has been with Rolls-Royce for more than 15 years, most recently as the leader of HR in our civil aerospace business, where she had a pivotal role in delivering that restructuring programme I talked about a moment ago. And in January, Rob Watson, president of Rolls-Royce Electrical, joined our executive team. Rob's been with us for 10 years, and over the last 4 years, he's played a fundamental role in the development of our Rolls-Royce Electrical business as we invest for a more sustainable future. We have a strong, capable and driven executive team, and I'm very confident in their ability to deliver our vision for the future. So thank you, and now over to Panos to talk about our financial performance.
Morning everybody, and thank you, Warren. We are very proud of our achievements in 2021. Against a backdrop of challenging and unpredictable market conditions, we've delivered improved financial performance that's been driven by cost reduction and market growth. The results you can see on these slides, well, they're all presented on an underlying basis, and that's for the continuing businesses in the group. Revenue, that stayed steady. So it's less than 2% lower than 2020, and we've seen a much more balanced contribution from across our businesses, with civil aerospace now contributing around 40% of the total. Lower wide-body volumes and lower shop visits in civil aerospace were balanced by growth in both defence and power systems. Operating profit, that was 414 million, and that's a 2.5 billion improvement compared with 2020. And that reflects the significant cost savings from the restructuring programme, that was largely focused on civil aerospace. Defence performed well and more than covered its increased R&D spend. Power systems, that grew strongly. It benefited from recovering end markets and better utilisation on the shop floor. The underlying loss of 2 billion in the prior year, well, that included 1.3 billion of one-off charges in civil aerospace, and those were mostly related to the impact of COVID-19. Free cash flow in 2021, that was an outflow of 1.5 billion, but again, that was substantially improved on the prior year. We saw great progress on cost reduction, stronger operating performance. That included higher flying hour receipts in civil aerospace and much more targeted capital expenditure. The working capital outflow that you see, 800 million, that was mostly driven by concession payments and lower OE deliveries in civil aerospace. If you can look at the improvement on prior year, the prior year also included the non-repeat of 1.1 billion, the negative impact from the termination of invoice factoring in 2020. On the whole, a very substantial step in the right direction on our recovery journey. If we move on now to civil aerospace, the civil aerospace financial performance, again, significantly improved as we neared completion of our restructuring programme. Gradual market recovery and the non-repeat of those COVID-related one-off charges from 2020, that also helped enhance our financial performance. Overall, revenue was down 10% on prior year. If you break that down, OE revenues were down 29%, reflecting the reduction in engine deliveries as fewer large engines were required to fulfill customer build schedules, whilst sales of spare engines, they increased. Business aviation OE deliveries were down as we transitioned to newer engine programs, which are now growing well from a low base. Services revenue was up 6% on the prior year and included 214 million of positive long-term service agreement catch-ups, compared with a negative catch-ups of 1 billion in 2020. They also reflected lower shop visit volumes and a reduced contribution from the V2500 engine programme. The underlying operating loss of 172 million was significantly better than the 2.5 billion loss in 2020. We continue to focus very heavily on those areas that are in our control, and we're seeing sustainable cost benefits from that restructuring programme. Our trading cash outflow was 1.7 billion, again a substantial improvement from last year, 2020. That was driven by engine flying hours. They were up 11% compared with 2020. In fact, second half engine flying hours were up 57% year on year as COVID vaccination programmes, they enabled key routes to reopen, although they are still at reduced volumes. Lower operating costs, lower CapEx and working capital outflows in 2021, as well as the non-repeat of that invoice factoring termination in 2020, also contributed to that improvement in cash flow. If we turn now to defence. Our defence business continued to perform well, with strong demand for both OE and services driving growth in all of our end markets. That's combat, transport, submarines and naval. Underlying revenue, that increased by 5% on an organic basis to 3.4 billion, with services revenue up 6% and OE revenue up 3%. Underlying operating profit was 457 million. That's an increase of 3% compared with 2020. It was driven by sales growth and a positive mix towards higher margin spare parts and spare engine sales. Now that profit growth, that occurred despite a 28% increase in R&D spend. That was made to support our ongoing product development and the growth opportunities ahead of us. Trading cash flow was 377 million. That gives a cash conversion of around 80%. That's a fairly normal level for our defence business. The prior year, that trading cash flow, that included an adverse impact from the timing of deposit receipts. Finally, we have a strong order book in defence. That follows several years of high intake with a 5-year average book-to-bill of 1.1 times and 85% order cover for 2022. Moving on now to power systems. Our end markets recovered well over the course of 2021. The order intake of 3.3 billion was 24% higher than the prior year, with a much faster conversion seen to sales in that business than we would typically see in defence and civil aerospace. Order growth was strongest in marine, defence and power generation. Underlying revenue of 2.7 billion was up 3%. Services grew at 10% as product utilisation increased, OE broadly flat. Sales were higher in industrial and power generation, partly offset by lower activity in China. Underlying operating profit, 242 million, up 37%. Operating margin was 8.8%. That's 2.2 percentage points higher than the prior year. That's due to the mix of sales towards higher margin aftermarket spare parts, as well as improved utilisation in our manufacturing facilities. We also experienced lower warranty costs. Trading cash flow, 219 million, representing a cash conversion of around 90%, despite an increase in inventory related to the global supply chain disruption we experienced in the second half of 2021. If I move on to new markets, now we've separated out our early stage businesses, those that have got high growth potential, we've put them into a distinct reporting segment, new markets. This gives increased visibility to the investments we're making to address the new opportunities that are being created by the transition to net zero and the energy transition. There are two businesses currently in this segment, Rolls-Royce SMR and Rolls-Royce Electrical. These businesses, they leverage our existing engineering expertise and capabilities to develop new sustainable products. Rolls-Royce SMR secured 490 million of funding in 2021, including 50 million we committed ourselves. We've already received around 30 million of that funding, and the remaining cash inflow, that's going to be phased over the next few years to align with the underlying specific spend. In 2021, a ramp-up in investment saw R&D costs of 68 million, 16 million of that in SMR, and 52 million of that on electrical power and propulsion technology. Over the next 5 years, we anticipate spending over 1 billion in R&D in these businesses, although our cash spend will be considerably lower due to that third-party funding for SMRs. And new markets, they are naturally more challenging to forecast, given the pace of customer demand ramp-up and also the regulatory approval process. What is clear, though, is the fact that the potential opportunities for these businesses are significant. We believe they could generate more than 5 billion of combined annual revenues by the early 2030s. If we turn to the next slide, we've set out here our summary funds flow. We saw a 1.5 billion cash outflow in the year from continuing operations. That's a significant improvement on the 4.2 billion outflow in 2020, and much better than our expectations that we set out at the start of 2021. If you break the movement down, you can break it broadly down into 3 buckets. Firstly, we saw an operating performance improvement of around 2 billion. That was thanks largely to our cost savings in civil aerospace and also revenue growth in both defence and power systems. Secondly, our 800 million working capital outflow was 700 million better than 2020. That was mostly due to that non-repeat of the unwind of invoice factoring. That was partly offset by a planned increase in inventory in defence and power systems to meet both expected sales volumes as we went into 2022 and the impact of global supply chain disruption in power systems. And thirdly, around about 100 million of other impacts. That reflected lower CapEx, partially offset by the higher hedge book closeout costs in the year. Our free cash flow is continuing to improve. The combination of restructuring and growth driven by recovering end markets is putting us on track to get back to positive cash generation. Turning now to our balance sheet on the next slide. We are committed to rebuilding our balance sheet and returning to an investment-grade credit profile in the medium term. We're on the pathway to achieve this as we benefit from reducing uncertainty, improving financial performance, and our strong strategic focus on the energy transition. We've previously announced 4 disposals which are expected to generate around 2 billion in total proceeds, including approximately 200 million of retained cash. The final and largest of these disposals, ITP Aero, is still expected to complete in the first half of this year, pending the necessary regulatory approvals. Disposal proceeds, together with the underlying free cash flow generated by the group, will be used to reduce net debt. We ended the year 5.2 billion of net debt, including 1.8 billion of leases. Our liquidity position is strong. 7.1 billion of liquidity, including 2.6 billion in cash at the end of 2021. Now that is after we repaid during 2021 the 2021 750 million euro bond and also the 300 million COVID corporate financing facility. A strong balance sheet is very important for us. We will balance the pace of that rebuild with the investment opportunities across our portfolio to make sure that we maximise the long-term return for our shareholders. Moving on to investments. Our technology and engineering expertise gives us a critical role in enabling the transition to a low-carbon global economy. We have significantly upgraded our approach to analysing investment cases to place an even greater focus on sustainability and broader ESG considerations, whilst maintaining investment discipline. Our investment spend is very much focused on making our existing products compatible with net zero, pioneering new technologies that can meet the accelerating demand for cleaner technologies, as well as identifying additional applications for our current portfolio of technologies. It is key that we optimise our investments in order to most effectively deliver our strategy, maximise our return, and achieve our net zero commitments. Our investments in both SMRs and electrical propulsion create net zero solutions and opportunities in new end markets. We have best-in-class products in markets with high barriers to entry, and taking advantage of that, generating a healthy return on our investments, well, that's a priority for us. Now we've seen the 2021 financial performance, I just wanted to recap on the priorities that I set out to you all back in August. As a reminder, 3 priorities: deliver on our commitments, simplify how we report, and invest wisely for the future. Firstly, delivering on our commitments. Right now, I feel very comfortable that we're making great strides. We've delivered the sustainable savings from our restructuring programme, and we continue to make sure that a large proportion of the costs that have gone out stay out, even as the load grows, as demand grows. We've exceeded our 2 billion free cash flow guidance for 2021 by over 500 million. Now, 300 of that was due to concession slippages, and we shared that with you in December. And I'm not going to claim any credit for that. That's not controllable. The rest, though, around 200 million, is due to our improved trading and cost performance and surpassed the commitment despite engine flying hours being worse, frankly, than we expected when we set the guidance right at the start of 2021. Secondly, we do need to simplify, break down the complexity around our financials. There is progress to be made in having more straightforward financial communications. Now, I've taken some steps already to reduce the complexities, easier to understand disclosures, helping comparability between years and across peers. There is more to come during the course of 2022. I'm making sure that the changes we make align from the ground up with how we drive the businesses and reward performance. And thirdly, we will continue to invest wisely for the future, creating sustainable value. We are at a very exciting point, huge opportunity to lead our markets in the journey to net zero. We also have the opportunity to take our innovation and technology into new markets with incremental growth. And we won't stop investing in our current products either. There are good near-term returns available from increasing durability and efficiency. So as I said, 3 things: deliver on the commitments, simplify how we report, and invest wisely. If we move on to outlook, we are well positioned for the anticipated growth in our end markets. Despite some challenges around the pace of market recovery, global supply chain disruption, and rising inflation, I am confident that we will see continued positive momentum in our financial performance. We expect low to mid single-digit revenue growth in 2022. That's supported by a strong order book cover in both defence and power systems, and a continuation of the gradual improvement in civil aerospace, along with an expected increase in spare engine sales. We expect our operating profit margin to be broadly unchanged, as underlying operational improvement is balanced with increased engineering spend to develop sustainable growth opportunities, with a gradual shift in spend towards new markets, defence and power systems. We expect to generate modestly positive free cash flow in 2022, representing a substantial improvement on 2021. Now, that increase comes despite the concession slips that I mentioned earlier, going from 21 into 22. As has been the case in prior years, cash flow will be seasonally weighted towards the second half of the year. Looking further ahead, long-term revenue growth will be driven by technology and innovation opportunities and rising global demand for sustainable power. This will be supported by well-targeted investment. We aim to spend around 75% of our investment on lower carbon growth opportunities in the medium term. So, a lot of opportunities ahead, a lot of growth from the energy transition, a lot of variables to manage, and a much more agile and balanced business geared towards capturing that growth in a profitable and sustainable way. And with that, I'll hand back to Warren.
Thank you, Panos. Now, the title on this slide reflects the terminology that I used last month, actually, at our annual Senior Leadership Conference. Sustainable in both senses of the word. Given our products and markets, clearly sustainable in terms of climate and impact or not on climate change. But my internal message was very much more focused on sustainability in the business sense, meaning generating profits and cash from our activities and seeking growth. From a behavioural point of view, for our senior leaders, that means adopting a restless pursuit of ever greater levels of profit and return, holding our heads high, seeking out and capitalising on growth opportunities. And I'd like to focus for the next few minutes on how we're driving growth and sustainable value in our established businesses, civil aerospace, power systems and defence, before then moving on to the new markets. So I'll start with civil. The fundamental restructuring programme that we've delivered means that we now have much lower costs, much improved operational gearing. We can see significant growth in demand in our factories, and that's accompanied by only small incremental growth in our operating costs. This is extremely important as we continue to generate value from our large installed base. Around 2/3 of our engines are covered by long-term service contracts that will deliver value way out into the future. We also have more than half of the market share for new large engines, with more than 1,500 on our order book. Our current order book includes 58 Trent XWB engines for Airbus's recently launched A350 freighter. The A350F represents a great opportunity for us to take a share in a market that has been, until recently, dominated by Boeing and GE. We're also seeing fantastic growth opportunities in business aviation, where our family of Pearl engines is now offering market-leading power and efficiency and outstanding low noise and emissions performance. The slide here shows a picture from Dassault of their Falcon 10X. At the launch, we and Dassault revealed that they've chosen our Pearl 10X engine to exclusively power their brand new flagship aircraft. And Gulfstream have chosen our Plz 700 to exclusively power their new ultra-long-range business jet, the G800. That's in addition to its use already announced on the G700. Plz 700 testing is progressing very well, and we're now in the final phase of regulatory approvals. And we and Gulfstream are delighted with the results of the flight test programme, and we expect to receive certification later this year. So now I'll move on to defence. And we're seeing good growth opportunities in this business, and that's critical this business is critical to protecting people around the world. In 2021, we concluded a multi-year programme of investment to revitalise our facilities in Indianapolis, creating a world-class campus with advanced manufacturing capabilities on a smaller and more efficient footprint. Now, that's a very similar story, really, but on a smaller scale to the restructuring programme that we just spoke about in civil, baking in operational gearing, which enhances the benefit of future growth. And this was recognised last year as we secured the award for the highly competitive B-52 engine replacement programme, generating $2.6 billion of business for the coming decades, with entry into service towards the end of this decade. We intend to bring that operational gearing benefit to future growth as well as we pursue further design wins. And we remain in a competitive process, for instance, for the Future Long-Range Assault Aircraft programme in the US in partnership with Bell Textron. And a win here would be a very significant driver for our long-term growth in defence. Of course, back in the UK, we continue to work with our partners, the Ministry of Defence, BAE Systems, Leonardo and MBDA, on the Tempest programme, with developments including the recently announced collaboration with Japan on a power system demonstrator. We also continue to support the UK MOD in the collaboration announced last year between the UK, the US and Australia on nuclear submarines. Looking further ahead, and defence, of course, is a very long cycle business, we are supporting customer demand for novel products that deliver advances in technology and sustainability. Investment opportunities include areas such as hypersonics, small engines and even power in space. Now I'll move on to power systems. We saw order intake accelerate in power systems, with the business achieving the best ever order book in its history. We have a strong established position with our MTU brand engines and a loyal, sticky customer base of over 40,000 customers. We're focused on supporting the transition to net zero, and we've set some challenging targets to cut carbon dioxide emissions. For many, that means deploying microgrid solutions, like the one in the picture here, with renewables, storage combined with backup from reciprocating engines. And of course, in future, those reciprocating engines will be powered by synthetic fuels or hydrogen as we continue developing those technologies. In 2021, we formed a partnership with Cellcentric to develop hydrogen fuel cells. Following on from this, we've been awarded a significant contract to provide the first-of-a-kind net zero microgrid, which will combine fuel cells and hydrogen combustion engines for the port of Duisburg in Germany. And hold on to that thought for a moment, because I'll talk about airports in a little while. Some of the strongest demand this year has been from data center customers. Our standby power solution was recently chosen by a hyperscale data center customer, and as we expand our geographic reach, we'll grow market share in this space. Right, so that's our established businesses. Now we'll turn to what we call new markets, our newly established reporting segment, including both Rolls-Royce SMR and electrical. Whilst these businesses are at an early stage, as Panos explained, they come with huge growth potential focused on addressing the opportunities created by the transition to net zero. Starting with Rolls-Royce SMRs, we're using existing technology, which we've been taking to market for decades, over 60 years in fact, in our nuclear submarine work. The diversification here is into new markets, with nuclear power plants for both on-grid and off-grid applications. And we're seeing enormous amounts of support for this technology. In 2021, we secured a sizable third-party funding through a UK government grant and equity investment from strategic and financial partners. And this is helping us to fund our SMR design through the regulatory approval process and support us as we search for sites for those factories that will manufacture the first units. First orders for the UK market are anticipated within the next couple of years. SMRs are a core part of the UK government's 10-point plan for a green industrial revolution. Our SMR is designed to deliver 470 megawatts of power on a site that is only the size of 2 football pitches, and that's very power dense. They've been engineered for low cost and repeatable manufacture, making them competitively priced with solar and wind, but without the associated intermittency challenges and costs, and including all the costs of eventual decommissioning and waste management. What's also really exciting about SMRs is how they can support our other businesses in the necessary production of green hydrogen and net zero synthetic fuels. Now moving on to electrical. In Rolls-Royce Electrical, we see again high growth potential. This is where we take a relatively new technology to a market sector that we know very well. Rolls-Royce has the mix of technologies and the skills that we've built through decades of sector-specific knowledge and experience combined with market access, and that's what makes us win. With lots of people have the technical ability to work in electrical propulsion and power markets. We have aerospace in our DNA and a track record of success. It's relatively easy to build electrical machines. They're all around us in many different shapes and sizes. Typically low, compared with the world of aviation, the power capabilities of these is relatively low. To lift a heavy object into the sky and move it through the air for hundreds of miles needs much more power, and the energy required has to be carried in that vehicle as well. And that is getting into the realm of hard stuff. Weight, thermal management, structural integrity, all very challenging. Add extreme levels of safety and reliability too, and it all becomes extremely difficult in an aero application. But that's where the decades of experience and the depth of knowledge at Rolls-Royce makes the difference. We are highly differentiated. We have the experience and the expertise and the safety track record to succeed. And this is a growing market too. We've partnered with Vertical Aerospace, and we power their VX4 all-electric urban air mobility vehicle. Vertical has $5.5 billion worth of pre-orders for over 1,000 of these products from some of the world's biggest and most innovative airlines. We're also strategically partnered with Embraer's urban air mobility spin-out, Eve. By the end of last year, Eve had already secured over 1,700 of aircraft pre-orders worth $5.2 billion. And with a collaboration with Tecnam and Videro, announced at the half year, for an all-electric powertrain for the commuter market, and that's targeting entry into service in the mid-2020s. Our electrical business is not just for airborne solutions. We're combining our expertise in electricals with our experience in power systems to develop a business opportunity for energy and charging infrastructure for airports and for vertiports in preparation for the advanced air mobility market. All in all, it's an extremely exciting time for our electricals business with many tangible opportunities in the pipeline. So to summarise today's presentation and our full year results, we're proud to confirm that our financial performance is improving thanks to both cost reduction and market growth. We are delivering on the commitments that we promised, and we're investing to drive growth and deliver sustainable value into the future. Together, these make Rolls-Royce a better, balanced and more sustainable business. And with that, we'll turn over to Q&A.
Definitely feeling a little bit calmer after listening to the presentation. I don't think the stock deserved a 20% dip, and I think they might be underestimating the recovery of international travel this coming year. Once again, this presentation took place right at the beginning of the whole Russia-Ukraine situation, and that coupled with the CEO Warren East leaving, who a lot of people have come to trust, and he's kind of the senior experienced member who's been around the company for a long time. But yeah, guys, what do you think? It didn't seem so bad to me. I'm still super bullish. I think this is a great buying opportunity. Just the other day, the stock hit $1.17. And, you don't get many opportunities like that. At the same time, you guys, I'm not going all in. And I never go all in on anything. In my opinion, this is a great time to start a position, take a few bites, nibble on it. Don't go crazy. But yeah, guys, super bullish. That's all I got for today. Hope you all have a good one. Hope you all make tons of money trading. Stock Surfer, signing out.